Look at this chart for a moment. Just look at it. Don't try to find an entry. Don't reach for a moving average or start drawing trend lines. Just watch the way price has been moving, the rhythm of it, the texture. Because there's something happening here that most traders will never notice, and it has nothing to do with any indicator they've been taught to use. See the way those candles slow down just before they reach that cluster of highs. See how each push upward gets a little less committed, a little more hesitant. And then watch what happens right at the level where the previous two sessions topped out. Price nudges above it, barely, for just a moment, and then falls sharply back. A retail trader who's been watching this chart all morning sees that as a failed breakout, maybe a sign of weakness. He starts thinking about selling, and he wouldn't be entirely wrong. The reaction is real, but the reason behind it is something entirely different from what he thinks. That cluster of highs isn't resistance. It isn't a ceiling the market can't break through because sellers are too strong. What's sitting above those highs is a reservoir of orders. Stop losses from traders who've been short since the first high formed. Buy stops from breakout traders who wanted in the moment the level cleared. Both groups place their orders at the same obvious level, and neither group understands that their predictability has made them a target. The market doesn't move to where it should go next. It moves to where the orders are. And right now, above those highs, there's a pool of orders substantial enough to be worth acquiring. So what you're watching isn't price failing to break out. You're watching pressure being allowed to build, quietly, deliberately, until the pool above is dense enough to absorb the institutional order that needs to be filled. This is the lens through which everything else in this analysis will be read. Keep it in mind, because it explains every move we're about to observe. Before we let this chart continue developing, it's worth stepping back and looking at where we are in the larger picture, not because the smaller time frame isn't telling us something, and it is, but because what it's telling us only makes sense in context. Pull the view out to the weekly. This instrument has been in a steady uptrend for several months, not a violent parabolic trend, a measured one. The kind of trend that takes weeks to form swing highs and weeks to form swing lows. The kind that institutions build. The weekly structure here is unambiguous. Higher highs, higher lows, each swing expanding the range slightly, each pullback finding support before the previous low becomes threatened. Somewhere inside that weekly trend, a pullback is underway. The daily chart shows it clearly. After the last significant weekly high formed, the daily began a sequence of lower closes, 4 of them, then 5, then 6. From a daily perspective, if that's all you're watching, this looks like the beginning of something more serious. The candles are consistently bearish. The recent daily highs are lower than the previous ones. A trader watching only the daily might think the trend has changed, but the weekly context hasn't changed. The weekly structure is still intact. What the daily is showing is a retracement, not a reversal. And that distinction is everything, because a retracement in the context of an intact weekly uptrend is not a reason to sell. It's a setup in progress. The question the daily is actually answering is not, is this trend over? It's how far does this retracement go before the weekly resumes? And to answer that, you need to understand where value is. Somewhere below the current daily price, there's a zone where institutional interest lives, where the buyers who drove the weekly trend are willing to re-engage, where the price becomes attractive enough to absorb whatever selling pressure the retracement has generated. That zone is defined by 2 things: the structure of the weekly move itself, specifically the fair value gap left behind when the last major weekly displacement occurred, and the liquidity that the current pullback has been generating on its way down. The stop losses of long positions that entered on the way up, now clustered at the swing lows the daily has been creating. Watch how those 2 things begin to converge as the daily continues lower. Daily pullback is now on its fifth session. Each day price makes a lower high and a lower close. The candles are not particularly aggressive. This isn't panic selling. It has the texture of a controlled, deliberate retrace. The kind that happens when the buyers simply step back, not because they've abandoned the trend, but because they're waiting. Waiting for exactly the zone we can see forming below. Look at where the daily lows are landing. The first pullback low formed at a level that aligns almost precisely with the top of the weekly displacement zone, the area where price moved so aggressively upward during the previous rally that it left an imbalance, an area where the market passed through price levels without completing the normal two-sided process that price discovery requires. Buyers and sellers didn't fully negotiate at those prices during the impulse. The market simply moved through. That imbalance exists as a structural memory. Price has a tendency, not a guarantee, but a genuine tendency, to return to those zones, not to fill a gap in the abstract sense, but because the institutional participants who built the original move are still referencing those price levels as areas of value. When the retracement brings price back down into that zone, those same participants begin to re-engage. The imbalance becomes a magnet. And now, as the daily approaches that zone, something else is happening simultaneously. The retracement itself has been generating liquidity. Every day that the pullback continued, long positions that entered the trend earlier were being slowly pressured. Their stop losses, typically placed below recent swing lows, have been accumulating. Each new daily low creates another cluster of stops just below it. By the time the daily price arrives at the imbalance zone, the confluence is significant. You have institutional buyers re-engaging because the price has returned to their area of value, and you have a pool of stop orders sitting just below the recent lows. Stop orders that, when triggered, will produce a burst of sell-side order flow that the institutional buyers can absorb directly into their position. This is where patience in top-down analysis pays off. You're not reacting to the daily candles as they form. You're watching for the moment the daily brings price to the exact confluence of these two conditions, the imbalance zone and the stop cluster. Because when both conditions are met simultaneously, the probability of a strong reversal is at its highest. Drop to the 4-hour chart now. The daily context has given us everything we need to frame what we're watching here, a retracement into a zone of genuine institutional interest. But the 4-hour is where the actual story begins to take shape, with enough resolution to read. The 4-hour pullback has created something clean. 3 distinct swing lows have formed during the correction, each one slightly lower than the last, not dramatically lower. The steps are measured. And at the bottom of the third step, 2 of those swing lows land at almost exactly the same price level, equal lows. The market has tested this level twice, bounced both times, and is now approaching it a third time. These equal lows are not a coincidence. They're not strong support. What they represent is a visible, obvious, widely watched level. Exactly the kind of level that traders across the market have noticed. Short-term traders who entered long at the lows have stops sitting just below them. Breakout traders who want to enter short if the level breaks have orders triggered by a move below it. And the fact that the level has held twice already has increased the density of those orders. Every time price bounced from this area, more traders anchored their positioning to it. Below those equal lows right now is a pool of orders, not a hypothetical one, a real, measurable accumulation of buy-stop exits and short entries that will execute automatically the moment price drops below the level. And below that pool of triggered orders, sitting just inside the weekly imbalance zone, is where the institutional buyers are waiting. Watch what the 4-hour price does next. It approaches the equal lows for the third time. The candles compress, the volatility narrows. You can almost feel the hesitation. Both sides of the market coiled, waiting for something to break. And then it does. A single 4-hour candle extends below the equal lows, clean through. Every sell stop triggers. Every short breakout order fills. The order flow that generates from those triggered positions is significant. This is exactly the kind of aggressive selling that an institution needs in order to fill a large buy order without moving the market against itself. And now look at where the candle closes. It closes back above the equal low level. The wick went through, the body came back. That is not a breakdown. That is a sweep. And the distinction changes everything. If this were a genuine breakdown, the candle body would have closed below the level and the follow-through would have continued. The next candles would press lower. The swing lows would become resistance on the next rally. That's not what's happening. What's happening is that price reached below the level, triggered everything sitting there, and then immediately found more buy interest than sell interest. The body closing back above the swept level is the market's way of showing that the sell-side liquidity has been absorbed. The pool has been drawn down. And the entity that absorbed it, the institution that was waiting at the imbalance zone below, has now filled its position. The next 4-hour candle opens, and something shifts. It's not dramatic at first. A modest, bullish body. But the character of the candle is different from everything that came before it in the pullback. Where the previous candles had upper wicks and lower closes, this one has a lower wick and an upper close. Where the previous candles were hesitant, this one has conviction. Watch the third candle after the sweep. That's the one that tells the full story. It's large. It moves with purpose. It clears the high of the sweep candle. It clears the high of the candle before the sweep. And as it closes, it leaves a gap between its open and the low of the candle 2 positions back. A space where price moved so quickly upward that no negotiation happened at those levels. An imbalance in the upward direction. A fair value gap. The move has begun, but it won't move in a straight line. It never does. Zoom into the 1-hour chart and watch what happens in the hours following that 4-hour sweep and displacement. The initial impulse carries price upward several hundred ticks, clean, fast, committed. Then it slows. The 1-hour candles start to compress again. A minor high forms. Price retraces back toward where it came from. This is the moment that loses most traders. They saw the sweep. They saw the displacement. They entered long. And now price is moving back toward their entry and they're nervous. Is the sweep failing? Is the move reversing? Look at the 1-hour internal structure. The retracement is creating lower highs and lower lows on the 1-hour, which sounds alarming if you're watching the 1-hour in isolation. But zoom out to the 4-hour context. The 4-hour hasn't broken anything. The sweep low is still holding. The displacement candles range hasn't been violated. This 1-hour internal weakness is not structural decay. It's a pullback into the fair value gap that the displacement left behind. That gap is sitting below the current 1-hour price. As the retracement continues, watch where it finds resistance. Or more precisely, watch where it finds its first meaningful reaction. The 1-hour candle that touches the upper boundary of the fair value gap does something specific. It tries to push lower into the gap, extends slightly below the boundary, and then the very next candle closes above the boundary again. It's a small, contained version of the same sweep dynamic that happened on the 4-hour. A brief excursion into the imbalance zone, a quick reaction, and the beginning of a continuation. This is the entry. Not the 4-hour sweep candle, not the displacement candle. Here, where the 1-hour has retraced into the fair value gap, where the price has returned to the area of incomplete price discovery that the displacement created, and where the structure is showing the first micro-level confirmation that the retracement is over. The stop goes below the lowest wick that touched the fair value gap, below the displaced structure, below the point at which the institutional logic of the setup becomes invalid. If price goes below the sweep low, the analysis is wrong. That's the line. The target is the structure above, the 4-hour BSL that's been sitting untouched since before the pullback began. Those equal highs from the top of the trend, where retail breakout buyers and short sellers both have orders clustered, the next pool of liquidity the market will move toward once this buy-side position has been established. While the trade is active and the market is working toward the first target, it's worth watching the individual candle behavior on the 15-minute. Not to second-guess the trade, but because the 15-minute tells you things about the quality of the move that the 1-hour can't show at this resolution. The first 15-minute candle off the fair value gap reaction is telling. It has almost no upper wick. That means buyers stepped in immediately. There was no hesitation, no back and forth at the zone. The close is near the candle high. That's the signature of clean, directional buying, not retail accumulation, not a slow, grinding recovery. This is the kind of buying that happens when a large position has been filled at the zone, and the order is now driving price away from it. Watch the second candle. It extends the range of the first, same structure, small lower wick, upper close. The third candle breaks above the swing high that was made just before the retracement into the gap. That break of the retracement high on the 15-minute is significant. On any time frame, when the internal structure of a corrective move is broken to the upside, when the lower high sequence of the pullback gives way to a higher high, that's the market telling you the correction is finished. The 15-minute internal structure has shifted. The character of price behavior has changed. This is what change of character means in practice, not a labeled pattern, not a defined candle shape. It's the precise moment when the character of price movement transitions from corrective to impulsive, from hesitant to committed, from lower highs and lower lows to a sequence that is no longer operating in that pattern. The 15-minute internal shift confirms what the 4-hour context already suggested and what the 1-hour FVG reaction initiated. All three timeframes are now telling the same story. The position is clean. The target remains the BSL above. Let the 1-hour chart run forward. The next several candles continue the move. Each one holds its gains. The pullbacks are shallow. Brief pauses where price consolidates before continuing. This is the texture of a trending move with institutional participation. It doesn't correct deeply because the buyers who drove the displacement are still active. They're not exiting yet. They're holding toward their own targets. The first significant pause comes about 2/3 of the way to the target. Price has been making steady progress, then suddenly 3 consecutive 1-hour candles barely move. They open and close at nearly the same price. Wicks in both directions, bodies nearly flat. A consolidation. A retail trader watching this might interpret it as the move stalling, might start thinking about partial exits. But look at the structure of those consolidation candles more carefully. The lows are higher than the candles before them. Each time price attempts to push lower during the consolidation, it finds buyers before it can reach the low of the previous candle. That's not a market that's losing momentum. That's a market absorbing selling pressure without giving ground, which is the internal structure of continuation, not reversal. The consolidation breaks to the upside on the 4th candle, a clean breakout through the consolidation range, closing near the high of the session. The move resumes. What that consolidation was, mechanically, was the market allowing time for the institutional buy order to be scaled into as the price appreciated. Large positions aren't managed with a single entry and a single exit. They're built in layers, managed dynamically, with portions added during brief consolidations and portions trimmed during quick spikes. The flat candles weren't indecision, they were order management. The target comes into view on the 4-hour chart. Above the current price, clearly visible, are the equal highs that formed at the top of the trend before the pullback began. These are the highs that retail traders who missed the original breakout have been watching for their entry. These are the highs where short sellers who've been fighting the trend have placed their stops. Both groups have orders at that level. Watch how price approaches it. The 1-hour candles slow as they near the equal highs. Not dramatically, but there's a measurable decrease in momentum. The range of individual candles narrows slightly. The wicks start to appear on top of the candles where before they were appearing on the bottom. The market is coiling again. And then a single 1-hour candle extends above the equal highs, exactly far enough to trigger the orders sitting there. The buy stops, the short stops, the breakout entries. And then it closes. Look where it closes. Below the equal highs. The wick went through, the body closed below. Every order above the level was triggered, and the resulting order flow was absorbed. The institution that has been driving this move from the fair value gap entry is now trimming the position, selling into the liquidity that just got triggered above the highs, scaling out at exactly the level where the market generated enough opposing order flow to fill a significant sell interest. This is how the target is hit in practice, not a clean stop at the high watermark. A sweep above the equal highs, one candle, sometimes two, that triggers all the orders clustered there, absorbs them, and then pulls back below the level. The position that was entered at the fair value gap is closed into that sweep, at a price slightly above the equal highs, into the exact moment when maximum buying pressure was created. The retail trader who watched the move from the outside and finally entered the breakout above the equal highs, the trader who had been waiting for that confirmation, is now holding a long position that was entered at the sweep high. Their stop is below the equal highs, and within 2 candles, that stop will be triggered. Step back from the execution and look at the full structure of what just happened on the 4-hour. A complete institutional sequence, from beginning to end. The pullback brought price into the weekly imbalance zone. The 4-hour equal lows provided the sell-side liquidity for the entry. The displacement left a fair value gap for the 1-hour reaction. The 15-minute confirmed the structural shift. The equal highs at the top of the trend provided the buy-side liquidity for the exit. Every stage of the move was connected to liquidity, either consuming it at entry or targeting it at exit. The imbalance zone was the structural reason. The liquidity sweep was the mechanical trigger. The fair value gap was the precision entry. The equal highs were the target. None of those were separate concepts. They were sequential phases of a single institutional operation, understanding them as isolated ideas. This is where FVGs matter. This is where sweeps matter. This is where equal highs matter. Is the wrong way to hold this knowledge. They are one continuous chain of causation. The imbalance zone exists because of how fast the original impulse moved. The equal lows formed because of how the pullback developed. The sweep happened because the equal lows created the liquidity pool. The displacement happened because the sweep absorbed the pool. The fair value gap formed because the displacement moved too quickly. The reaction at the gap happened because institutional buying resumed there. The move continued because the position had been established at value. The equal high sweep happened because the BSL was the logical exit. Each event made the next one not just possible, but probable. Now look at the daily chart of a different instrument and notice something immediately. The structure here is the mirror image of what we were just watching. Where the previous chart had a weekly uptrend with a daily pullback, this chart has a weekly downtrend with a daily correction. The weekly structure is making lower highs and lower lows with the same measured regularity. A bearish displacement occurred 3 weeks ago. A large weekly candle that broke below a range that had held for a month. That displacement left an imbalance above the current price, a zone where price moved through so quickly that the upside levels were never properly negotiated. The daily correction is now pushing up toward that zone. 6 days of steadily higher closes, each day recovering a portion of the bearish weekly displacement. From a daily perspective isolated, this looks like a recovery. The candles are bullish. The structure is making higher highs and higher lows on the daily. Retail traders watching only the daily might consider this the beginning of a bullish reversal. But the weekly imbalance is sitting directly above. That zone, the range price passed through during the bearish displacement, is an area where the institutional sellers who drove that weekly candle are still referencing as supply, where they would be willing to add to their short positions if price returned to give them the opportunity. The daily correction is providing exactly that opportunity. The correction doesn't need to reach the top of the imbalance zone to be rejected. It needs to reach far enough inside it that the institutional sellers can re-engage with meaningful size. That point is often the midpoint of the imbalance zone or the first level of reaction within it, not the full fill of the gap. Watch the daily correction approach the zone. The candles are still bullish on the surface, but the range of each candle is narrowing as price enters the imbalance area. The close to high ratio, how far the close is from the candle high, starts to decrease. These are the micro signals of distribution beginning. Drop to the 4-hour chart and watch the correction develop at higher resolution. The equal highs forming at the top of the 4-hour correction are growing more defined. 3 pushes have now reached approximately the same level. The third push is slightly higher than the second, which was slightly higher than the first, but the difference is marginal. From a structural memory perspective, these are effectively equal highs. A visible, obvious, identifiable level with orders accumulating above it. Buy stops from traders who are long and want to lock in profits above the high. Short entries from traders who want to sell the rejection at resistance. And crucially, the stops of the retail buyers who entered long on the daily correction candles, which are positioned just above the highest point the correction has reached. The buy-side liquidity above these equal highs is substantial, and it's sitting exactly at the top boundary of the weekly bearish imbalance zone. The 4-hour structure of the correction looks like a classic 5-wave advance to a retail technician. Clean impulse legs, clean corrective legs, each wave building on the last. In isolation, it looks like accumulation, like the beginning of a larger bullish move. And that reading is exactly what makes the trap effective. A 4-hour candle breaks above the equal highs, just barely. The high of the candle exceeds the highest point the correction has reached by a small but measurable margin. Every buy stop above the level triggers. Every short entry sell stop above the level triggers. The resulting order flow generates a surge of buying. And that surge is the liquidity that the institutional sellers, who have been waiting at the imbalance zone, now have available to sell into. Look at how this candle closes. The body closes at the lower end of the candle range. Almost everything the candle gained during the wick extension above the equal highs has been given back, and the candle after it opens and immediately moves lower. Not hesitates, not consolidates, moves lower with decisiveness. This is the displacement in the bearish direction. The sweep of the equal highs absorbed the buy-side liquidity. All those orders above the level provided the volume that the institutional sellers needed to fill their short position. And now, with the position filled, price is free to move toward its next target. The next target is visible on the 4-hour chart, below the correction starting point, where the bearish weekly move established the first significant low before the correction began. A pool of sell-side liquidity is waiting. The traders who held long through the correction and got stopped above the equal highs. Their positions are now gone. but traders who went long at the start of the correction still have their stops sitting below the pre-correction low. That's the next pool. The 5-minute chart of the bearish displacement is striking in its clarity. 2 consecutive 5-minute candles, both large-bodied and bearish, moving rapidly through a price range that took the correction several days to build. No wicks worth mentioning. Closes at the candle lows. This is the institutional signature of a committed position being expressed, not retail selling, not stop losses cascading, but directional order flow from a participant who has decided where they want price to go. Between those 2 5-minute candles, there's a gap. The close of the first candle and the open of the second candle left a range of prices where the market simply didn't trade. A 5-minute bearish imbalance. A fair value gap in the downward direction. On the 1-hour chart, the first reaction following the displacement is a modest pullback. 3 1-hour candles retrace a portion of the bearish move. The correction is shallow, barely 40% of the displacement range. And when you mark the levels of the 5-minute imbalance onto the 1-hour chart, you can see exactly where those 3 pullback candles stopped. They stopped at the bottom boundary of the 5-minute fair value gap. Price returned to the exact area of the bearish displacement imbalance, reached the lower edge of the gap, and found sellers again. The gap held. The retracement is over. This is the short entry. The equal high sweep confirmed the bearish institutional intent. The displacement confirmed the committed directional order flow. The fair value gap provided the precise re-entry level, the area of price that the market treated as supply when the displacement moved through it, and is treating as supply again now that price has returned. Stop above the wick of the equal high sweep. Nowhere else makes structural sense. If price reaches above that sweep high, the setup is invalidated. The institution's short position, which required the BSL above the equal highs to fill, would be underwater, which means the original institutional logic has broken down. The stop is not a risk management tool placed at an arbitrary distance. It's a structural invalidation point. The target is the pre-correction low, the sell-side liquidity pool that formed when the weekly bearish displacement established its lowest point before the correction began. Long positions that survived through the correction still have stops there. Breakout shorts, waiting for that low to break, have orders there. The next pool of orders is the next target. Straight line, clean concept. Watch the 1-hour chart continue developing over the next several sessions. The initial move off the fair value gap rejection is sharp. Bearish candles, widening ranges, consistent closes near the candle lows. This has the texture of institutional momentum. Not random selling, but directional pressure that has a destination. The market is moving with purpose. Then, on the 3rd day after the entry, the 1-hour structure makes a brief attempt at recovery. 4 or 5 1-hour candles move higher in a modest corrective sequence. Retail traders who missed the entry and are watching from the sidelines might see this as an opportunity to short the correction. Retail traders who are in the trade might start to question whether the move is stalling. Look at the 1-hour internal structure of that correction. The lower high sequence, each recovery attempt failing at a lower level than the previous one, is still intact. The pullback is creating lower highs and lower lows within the downtrend. The internal structure of the correction is bearish. This is not a structural threat to the trade. It's a brief consolidation that is, once again, generating the liquidity necessary for the next leg lower. Above the correction's highest point, there are now fresh buy stops from traders who shorted the correction and placed their stops above the highest recovery candle. That's the next minor BSL. And true to the pattern, the 1-hour correction pushes just above that level, triggering those stops before rolling over and resuming the downtrend. Smaller liquidity pools, smaller sweeps, but the same mechanics operating on a shorter time horizon, driven by the same institutional logic that explain the 4-hour sweep of the equal highs. The target low is reached 6 sessions after the entry. A single large bearish daily candle sweeps through the pre-correction low, triggering all the sell stops accumulated there, and then continues lower through the session before recovering slightly into the close. The position is exited into that sweep, selling the last portion of the short at the moment of maximum downside momentum, precisely when the SSL pool generated the most aggressive selling to exit into. Every sequence we've observed, the bullish trade and the bearish trade, came from the same reading process, applied consistently, without forcing the analysis to fit a predetermined structure. The process always starts the same way. Before the price on any execution time frame is even looked at, the weekly context is established. Not as a ritual step, not as a checklist item, but because everything that happens on lower time frames is a consequence of what the weekly structure has already decided. The weekly tells you which direction has institutional backing. The weekly imbalances tell you where that backing is concentrated. The weekly swing highs and lows tell you which liquidity pools are substantial enough to generate major moves when swept. From the weekly context, the daily narrows the view. The daily doesn't change the direction the weekly has established. It refines the timing. A weekly that is bullish with price in a discount zone tells you that the daily pullback is not a reversal. It's an opportunity. The daily is the chapter in the story the weekly has written. It shows where the current paragraph is, how close price is to the institutional re-engagement zone, whether the pullback has been deep enough and long enough to have generated the sell-side liquidity the institutions need for their buy entries. Then the 4-hour. The 4-hour is where the specific setup architecture becomes visible. Equal highs, equal lows, the specific swing structure of the pullback, the exact level of the imbalance zone relative to current price. This is the time frame where you can begin to see the trap forming. The equal lows or equal highs that are clearly building a liquidity pool, the compression before the sweep, the setup geometry that tells you where the entry will come from and what form it will take. The 1 hour and 15 minute are where the sequence unfolds in real time. The sweep candle, the displacement, the internal change of character, the fair value gap retracement. None of these are new topics appearing in sequence. They're one event flowing into the next, each phase made possible by the phase before it, each phase making the next phase more probable. And the 5-minute is only ever used for the final precision. The exact candle that confirms the pullback into the fair value gap has completed. The exact body close that shows the reaction has begun. It doesn't change the trade. It refines the entry point and tightens the stop. There's a mistake worth examining in detail because it's one of the most common ways this type of analysis breaks down in practice, not from misunderstanding the concepts, but from applying them in the wrong sequence. Consider a trader who watches the sequence we just described on the bearish trade. He understands the equal high sweep. He understands the fair value gap. He sees the displacement, but he enters at the displacement candle itself, the moment the bearish candle breaks lower from the equal high wick, not at the fair value gap reaction. At the displacement candle, the entry looks and feels correct. The move is happening. He's in. But the displacement candle's range is wide. His stop, which needs to be above the equal high wick, is far from his entry. And because the displacement candle moved so aggressively, the risk on the trade is significantly larger than it would have been had he waited for the fair value gap reaction. When the 1 hour pullback into the fair value gap happens, which is a normal, expected part of the move, his unrealized profit compresses. The trade looks like it might be reversing. He's watching price move back toward his entry, back toward the top of the displacement. and the emotion of watching a winning trade approach break-even starts to affect his judgment. He either exits early, missing the full move, or he holds and endures the pullback at a far worse psychological position than he needed to be in. The trader who waited for the fair value gap reaction entered at a better price, with a tighter stop, at the moment the market showed him the reaction was beginning. He didn't experience the displacement as a trade. He experienced it as confirmation. The pullback into the fair value gap was his entry signal, not a threat to an existing position. The setup was the same. The execution sequence was different. The outcome, in terms of risk management, psychology, and position quality, was dramatically better. Patience in this methodology isn't a personality trait. It's a structural advantage. The market delivers the same information to everyone who's watching. What separates the outcome is whether you wait for the full sequence to develop before acting, or whether you reach for the entry at the first moment it becomes plausible. Think about how many trades we've described across this analysis. The bullish sequence, from the weekly context through the 4-hour sweep and displacement, to the 1-hour fair value gap entry, to the equal high target. The bearish sequence, from the weekly imbalance through the equal high sweep and bearish displacement, to the short entry on the gap pullback. 2 complete trades, each one requiring hours of observation, multiple time frame confirmation, a specific trigger event, and the discipline to wait for that trigger before executing. In the time it took to identify and execute both of those trades, a trader who was looking to be active every day might have taken 12 to 15 trades, short ones, long ones, scalps, counter-trend positions, reactive trades that felt justified in the moment, but lacked the full structure that makes the difference between a trade and a bet. The gap in long-term results between those two approaches isn't about intelligence. It isn't about which trader knows more concepts or understands more patterns. It's about what each trader does with their knowledge. One uses it to find reasons to act. The other uses it to filter everything that doesn't meet the full confluence standard, and only acts on what remains. What remains, when you apply the full top-down filter, is rare. That's the point. The scarcity is the quality guarantee. A 5-minute setup without 4-hour confirmation is not a trade. A 4-hour sweep without weekly context is not a trade. An entry without a structural stop is not a trade. The full sequence, aligned from the highest time frame to the execution time frame, with a liquidity sweep for the trigger and a fair value gap for the precision. That's the trade. Everything else is the market offering you the illusion of opportunity to generate the retail order flow it needs to fuel the real moves. Risk management in this framework isn't a separate topic added at the end. It's embedded in the structure of every entry decision. The stop isn't placed after the trade is decided. It's part of the trade logic from the beginning. When you enter at the fair value gap reaction, the structural stop is already defined before you enter. It sits below the lowest point of the liquidity sweep, below the wick that triggered the stops and swept the pool, below the point at which the institutional sweep has been violated. If price returns to that level after the displacement, the sweep is invalid. The trade idea is invalid. The stop is not arbitrary. It's the exact price at which the logic breaks down. That stop distance, from the fair value gap entry to the sweep low, tells you the dollar value of the trade's risk. If that distance is 20 points and you're willing to risk $500 on the trade, the math gives you your position size. Simple, structural, mechanical. No guessing required. The targets are equally structural, not ratio-based, not I want a 2-to-1 trade imposed from the outside. The target is the next liquidity pool in the direction of the trade, the next equal highs or equal lows, the next session high or session low, the next imbalance zone that's likely to cause a reaction. Price moves to where the orders are. The targets are where the orders are. Managing the position through the move. When to take partial profits, when to trail the stop, when to let it run, follows from reading the structure as it develops. When the internal structure of the move shows the first signs of correction, when the candle ranges start narrowing, when the retracement character appears, those are the signals to manage. Not a fixed percentage gain, not a timer. The structure itself tells you what it's doing. This isn't rigid. It requires active reading. But active reading of the market's actual behavior is the only form of risk management that scales with the methodology. A fixed rule that doesn't account for the market structure it's being applied to will eventually conflict with reality. Structural risk management never does, because it's drawn from the same analytical framework that generated the trade in the first place. Watch this chart one more time. Not as a student looking for a concept to apply, just as an observer watching price move through time. See how the candles breathe. How some sessions are wide, committed, directional, displacement energy, institutional intent made visible. How others are narrow, compressed, coiling, the market absorbing, digesting, preparing. How the sweeps below obvious lows always seem to produce the sharpest reversals. How the rallies that look the most convincing on the surface, the ones that make retail traders chase the breakout, so often end in a single wick above the equal highs, a body that closes back below, and then nothing but downward momentum for sessions afterward. The market is not complex. It is consistent. The same pattern of behavior operating across the same time frame hierarchy, driven by the same institutional logic of liquidity, acquisition, and position management, repeating itself across every instrument, every session, every week, not identically. The specific geometry changes, the timing varies, the instruments have their own personalities and ranges, but the underlying logic is invariant. The sweep precedes the displacement. The displacement creates the imbalance. The imbalance becomes the entry. The opposing liquidity pool becomes the target. If you've watched this analysis and found yourself beginning to see the chart differently, not as a collection of patterns to memorize, but as an evolving story being told by the participants inside it, then the work of this session has been done. The goal was never to add concepts to a list. It was to shift the frame of reference from which you observe the market entirely. Look at the chart differently from this point forward. Ask who placed the orders at every obvious level. Ask what happens to those orders when price reaches them. Ask who needs what to happen at this price, and what they need price to do next in order to get it. Ask why this particular candle moved with conviction when the ones before it were hesitant. The market answers those questions, every session, every candle, in the only language it has, which is price and what it does at the levels where orders are waiting. That language, once learned, is not forgotten.